The broadcast is now starting. All attendees are in listen-only mode.
All right. Good evening, everyone. Okay, welcome to today's sharing. So today's topic here will be introducing to you the aspect of seasonal analysis, right? We call it seasonal trade ideas over here. Okay, so I'll spend a little bit of time to really show you what it means by seasonality, okay, to understand the concept of that. And then I'll show you in terms of how this can actually be applied to the stock market as well as the forex currency market at the same time. Okay, so this strategy itself, it's one of the strategy that I'm using as well, primarily for stocks trading. Okay, and it's also to build up again. This 2 months here, we're doing kind of like strategy series to really build up your toolkit, your methods, which you are able to then use it to trade and analyze the market. Okay, so today we'll talk about this. Okay, and this strategy over here has in fact made a 300, in fact more than 300% of ROI for the past 1 year. Okay, and this is a technique that I've been actively using and sharing it with some of our traders as well since October 2020. Okay, and of course, to right now, November 2021 is slightly more than a year, and we have got more than 200% ROI from it. Okay, so it's definitely one of very profitable strategy that you can consider. And today I'm going to show you what it means, right? What is seasonal analysis? Okay, so over here, seasonal analysis, some of you who are more active perhaps in the stock market probably come across this term before. Okay, and as the name itself suggests, I think it's not too foreign, right? I mean, the idea of seasonal is pretty straightforward. You are looking at seasons of the year. Okay, so one of the most common understanding of season is, of course, we have spring, summer, autumn, and winter. Okay, so the idea is we are actually looking at a certain patterns that tend to repeat itself over and over again. And of course, when we talk about like spring, summer, autumn, and winter, it's actually a pattern within the year, right? Like 3 months we're in spring, and then it converts, we rotate into summer period, etc. Okay, so the idea is basically looking at patterns that tends to repeat itself year on year. Okay, and we are actually analyzing this method based on historical statistics. Okay, and one of the most common duration that we look at from seasonal perspective is the past 10 years. Right, sometimes you might see traders who are using seasonal analysis perhaps would use like 15 years of data, 20 years of data, or even up to 30 or even 50 years of data. For me, I primarily use the recent 10 years because I'm doing more of like trades, right? I'm not looking at very, very long term. So 10 years to me is more than enough. Okay. So to give you an idea of what it is, right, I'm going to show you some example of seasonal analysis that's being applied to maybe day-to-day life. Okay. Now, recently, I'm not sure how many are F1 fan, right? But this year, 2021 season in the Formula One, okay, it's pretty exciting because we do have like 2 drivers competing for championship, and we are like less than 5 races. Okay, and we have 2 constructors, which is basically the manufacturer of the car. 2 companies are also competing for the championship. Okay, and it's pretty exciting. But why I bring this example up is to really showcase to you, like, if today you're not an F1 fan, right? You're not like basically following what's happening in Formula One. You have no idea who is the champion, who is the one leading, or which constructor is potentially gonna win. No worries, okay? Because with seasonal and statistics, right? Even with someone who doesn't know anything about F1 can actually make a pretty good guess, right? And that's the idea of seasonal analysis. You're looking at patterns, right? So if you today look at the historical stats, right? Since 2014 until 2020, Okay, you can see the name Lewis Hamilton appearing, quite almost every time since 2014 to 2020. He was the champion since then, right? All the way until 2020, from 2014 to 2020, except for 2016. Okay, and if you look at the constructor, which is basically the manufacturer of the car, Mercedes has been winning all the way since 2014. Okay, and if just based on this information that I've just provided to you, okay, if let's say today you have no idea what F1 is, you never follow it, okay, and I just ask you to, based on this information, make your best guess for 2021, which driver is going to win, okay, and which constructor is likely going to win. Okay, I think I would say almost every one of you who perhaps doesn't follow F1 looking at the stats would just say Lewis Hamilton, which has been winning for the past 5 to 6 years, has a higher chance of winning this year as well. And of course, Mercedes, who has been winning consecutively since 2014, would have a higher chance of winning in 2021 as well. Okay, of course, it's not going to be 100%, that this is going to be true, but the best bet you can give yourself if you have no idea what's happening right now is just based on historical stat. Okay, and that decision itself, okay, it's actually based on seasonality, right? Based on historical information, you can't make a decision for the future. Okay, now same thing over here if you apply it into, let's say, vacation. Okay, and today, let's say you're planning to go to the East Coast in Malaysia, go to the beach, outdoor activity and things like that. Definitely you'll be considering, like, is it going to be a rainy season, right? Of course, like end of the year is going to be rainy season, okay? And you probably do not want to go over during this period, right? Because you won't be able to go out and enjoy it, right? Or probably you will not even enjoy the sun, okay? And this kind of subconscious decision where we even apply onto our day-to-day basis, it's actually also based on seasonality, right? And you're actually studying based on historical pattern, when is the rainy season. Okay, and if you take a look at this chart over here, this Malaysia annual average rainfall, you can see like since September to December, the average actually rally, right? The average actually go higher, which means there will be more rain coming into the end of the year. Okay, and based on this information, again, of course, it's not going to be every day raining, but there's a very good chance that end of the year we see more rain. Okay, and naturally, if you want to plan for outdoor activities, you probably do not want to plan it, end of the year, right? You probably plan it like maybe February, March period, or even like June, July period. Okay, so again, all this decision, where does it comes from? Okay, based on historical pattern, you make a decision today, right? Now, even if, let's say, we talk about durian, okay, I'm not sure how many of you are fans of durian. It has season as well, right? So if today you are, avid fan of durian, you like to eat it, you will probably also understand that there are some seasons for durians, right? And during peak period, the price of it is probably going to be cheaper. You probably have much better quality one because of the quantity you are able to choose as well, right? You can actually choose the better ones versus off-peak season where you have to pay a higher price to eat it. Okay, so if you take a look at that, in Malaysia itself, if you're going to understand the season of durian, okay, so Penang is during May and June. That's where the peak is. Pahang, it will be in July and August. Johor is July and August as well. And then in Sabah is August and September, right? So if, again, today you want to, really enjoy cheap durian yet good quality one, you're probably going to peak the season and really go out and enjoy it, okay, versus like off-peak season, right? So all this decision, I want you to be able to see, these are actually seasonal analysis as well, right? You're basing on historical patterns. You can't make a decision to assist you today or even moving forward in the future, okay? And if you bring this to the market, okay, in terms of the financial market, whether it's stock market, commodities market, or even the currency market, okay, there are such pattern as well, okay? And we're not talking about kind of like gut feel here, right? Because like rainfall, okay, it's not something that you guess, right? It's just based on past maybe 5 years, 10 years. That's how the pattern is, right? Based on durian production for the past 5 years, 10 years, that's how it is, okay? And therefore we have that kind of pattern. So same thing in the financial market. Okay, there are certain statistics that tend to happen where you can actually take advantage of it. Okay, so to give you some example that you might heard of it if you're a little bit more experienced in the equity side of things. One of the very common one is what we call like sell in May and go away. Okay, basically as the phrase suggests, right? During May period, or I would say during the beginning of May, right? That's where the market tends to be a little bit quiet, a little bit choppy, and people who are trading in the equities market would likely stay out of it. Okay, not too active, trading the equities market during that. That's also the summer period. Okay, and usually summer period, the financial market tends to be a little bit slower because people are going out for summer holidays, right? Okay, so those are some of the patterns. You probably also heard of like the September effect, okay, for example, or even the October effect, Hamster Effect, okay, Christmas rally, which is going to be very relevant to right now because we are going into end of the year with Christmas rally, and then you have like the January effect in the stock market as well. Okay, so these are actually seasonal as well. Okay, so let me share with you what I mean. So let's take a look at what September effect really is, right? So based on like past 50 years or so, right, when the market actually was there, okay, there is right the effect where during the month of September, generally speaking, the market tends to be weaker. Right? Again, weak stock market returns does not necessarily mean it's a bear market. It just means that maybe September is a flat month. Okay, it's basically not gonna give you any returns. If you're looking at general S&P 500, for example, okay, that's what it means. Okay, and if let's say today you understand, there is this tendency of happening, then maybe you can actually edit that aspect into your trades or even in terms of your investment journey, okay, to help you make a better decision. Okay, and the idea again, investors return from summer vacation during September, as I mentioned, right? May is where the summer period start, and then September is where the investors, really come back to work. That's where also, the effect comes because they're looking to kind of like lock in some gains, before the end of the year. And then you might also heard of the term, kind of like combing period, where going into the end of the year, some of the investors like to trim off their portfolio to close the year, looking very nice in terms of their portfolio, right? Because they are probably also paid off with the performance of their portfolio in terms of bonuses, right? So these are some of the things that they tend to do as well, which, every year they do it, and therefore it becomes a pattern. Okay, so if you take a look at like October also has a certain effect, right, where stock tends to decline during the month of October. Of course, it's not going to be happening every year, every October. Okay, but let's say based on the past 10 years, there's a good 7 times, this happened. Okay, and therefore you have this historical pattern, right? So the idea again, it can be multiple factors contributing to it. Okay, but over here, basically it can be a psychological expectation. Okay, where October kind of like Halloween effect as well, and October it's where if you take a look at historically, okay, a lot of market crash happens during October period, right? And that becomes something that psychologically maybe investors are a little bit worried. Okay, whenever October comes, they might be worried. Okay, will there be another big crash? Okay, and when major and many investors at the same time take precautionary action, then the market tends to be slower, right? Because they can sell off some of their profitable trades to protect their profits and things like that. Okay, so again, all these are again effects of it, right? So you can see all these major crashes actually happened in October, right? So in 1907, 1929, we have Black Tuesday, Black Thursday, Black Monday as well. Okay, so again, another one on 1987. A lot of major crashes happened in October, and that's the psychological effect. Okay, so there are many, right? So for example, another one here, Hamster Effect. Okay, some of this, of course, you can just Google it, and you'll be able to understand a little bit like the origins of all this effect, where this statistics comes about. Okay, but I want to show you again, all these things like January. I think January is something that some investors would look into. Okay, for example, they would say that if the year, okay, which is January, started off in a positive note, that means the equities market closed off in a positive month for Jan, okay, then very high chance the year would be closing off positive, right? So there has this effect here as well, okay. Again, sometimes you do not need to fully understand the reason as to why there's such an effect. But what I want to highlight over here is when you're looking at seasonal analysis, at the end of the day, you're actually looking at the historical pattern that tends to repeat itself reliably. Okay, of course, we're not going to look at 100%. There's no such thing. But again, what I mean by reliable is, let's say for the past 10 years, there's a good 7 to 80% probability it will happen. Then I think that's pretty reliable that you can expect it to repeat in the future as well. Okay, so again, all this here, I'm not going to go into all the details, but I think you get the idea of it. Okay, so as a trader, okay, I just want to share with you, if today you want to explore into this, you are basically studying the statistical pattern. Okay, so you can study the statistical pattern of the currency market, right? You can study the pattern of commodities market, you can study the pattern of indices, or you can study the pattern of individual stock. Okay. Today I'm going to give you a very simple model to give you an idea of how you study the patterns. Okay, and we're going to use the stock Starbucks later on to give you a rough idea of how this is being done. Okay, but of course that's a very, very simplified model because this is more of like introducing you to this. Okay, but if you really want to study it, you probably need to spend more time to really fully understand the mechanics of it. Okay, so the common question I always ask myself is there a recurring pattern for the past 10 years, right? Sometimes I look into 15 or 20 years, but I think the minimum here is 10 years, okay? And when there is a certain pattern that tends to repeat itself over and over for the past 10 years, then it becomes reliable, right? Because there's a certain pattern. Then the next question we'll ask is the pattern worth taking, okay? In terms of like risk versus reward, is it worth to take that risk, okay? Because it's not going to be 100%. So we want to also understand when we put in the amount of risk, is it worth the reward? Okay, so over here, let me show you this simple spreadsheet, right? So this is a very, something happened. Let me see if I can refresh that. Yeah. Okay, this is a very simplified model, okay, but the understanding is there, right? The principle is basically there. Okay, so you can see over here, this is a Starbucks, right? So what I did is I actually pulled out information using Google Finance, of course, in this very simplified model. Okay, I pull out information from 2011 all the way to 2020. Okay, and I'm going to study, every week from 2011 to 2020. You can see here, 2011 week 2 closes on the red. 2012 week 2 closes on the green, 2013 week 2 closes on the red, and etc. etc. Okay, and then you can see 1 year we do have 52 weeks, so I just basically extrapolate, pull out all the data that's relevant. Okay, so the first level of study is then reliability, which means I want to look out, for the past 10 years, is there a certain pattern? Okay, so if you take a look like week 2, right? Between 2011 to 2020, you can see there are only 3 times week 2 Starbucks closes in the red, right? And the other 7 years for week 2, Starbucks actually closes positive, right? And that gives me a 70% reliability, right? In other words, for the past 10 years, week 2, Starbucks has a 70% chance it rallied, right? So that's the idea of it, very straightforward. Okay, so if you take a look at, for example, like week 6 and week 7, okay, for the past 10 years, we have an 80% reliability, which means based on past 10 years, 8 years, Starbucks rallied between week 6 and week 7, right? Quite easy to understand from this logic, okay? We can, of course, also consider like reliability of 30%, okay? Of course, if you're looking at short selling, okay, 30% means, based on past 10 years, there's a 70% chance the stock drop. Okay, so that's the logic behind it as well. Okay, but today we're going to keep it simple, and let's say we focus only on upside for stock market, right? So if today we scroll into like the current week that we're in, Okay, for example, right now it's week 37 of 2021. Then we look at this, right? Based on Starbucks over here, okay, the historical pattern suggests that we have a 60% upside, right? Based on past 10 years, 6 years rally, 4 years did not, right? And to me, 60% is not a very good chance, okay? For me, a minimum of at least 70% or even higher than 70% would be more reliable. Okay, so if you take a look at week 48, which is actually next week, okay, we have a 90% chance of Starbucks rallying, which means based on past 10 years, this week 48, there's only 1 year it did not rally. Okay, and not only that, okay, we also consider the average rally for the past 10 years to kind of consider, is this risk worth taking? Okay, so just to very quickly show you an example, right? You can see here, this row, which is week 33, it has a 70% chance of rallying, but the average rally is only 0.37. Okay, we round a little bit, 0.37. However, if you take a look at next week here with a 90% chance of rallying, the average is 0.8. Okay, which means that while this 70% chance looks pretty reliable, okay, the average upside is limited. It's not a lot. Okay, so maybe, you know, with this consideration, like for the week 33, I'm not going to take that trade, okay, because while that's a reliable pattern, the reward is not worthwhile. Okay, so again, it's very statistically driven. Okay, so this is how you can understand seasonal a little bit more, right? So this is a very simplified model. Okay, and this technique here is free. Okay, anyway, if you know a little bit about Google Finance, you can pull out all this information and, you know, give yourself a little bit of time to go and play around with this understanding. Okay, but I hope this one here give you a good understanding of what seasonality is, right? So with that, okay, we mentioned, you know, we look at historical probability, which is the reliability factor. Okay, based on past 10 years, you know, is there a good number of years it rallied, and etc. Okay, we look at the average return, which is what we call profitability factor. Is it worth taking that trade? Okay, we do consider a little bit on the standard deviation as well. Of course, this one here is a little bit mathematical. Okay, but standard deviation, you can understand it as more like risk factor. Okay, if it drops, is it going to drop a lot? If it's rally, is it going to rally a lot compared to its average? Okay, so that's the basic understanding of standard deviation. Yeah. And of course, in financial market, we look at Sharpe ratio as well, which is your risk to reward ratio. Okay, so over here, just want to show you some stats so that you understand the power of seasonality and you can see it for yourself as well. Okay, so this one here, this stats a little bit, I would say, outdated. Okay, because this presentation I prepared in October. Okay, we are already in November, but based on 91 trades in October, right? So from October 2020 to October 2021, we took 91 trades in total based on seasonality. Okay, 81 were closed, and of course, there were 10 trades were running back then. Okay, out of this 81 trades that were closed, 30 were losses, 51 were winning. So we have about like 63% win rate. Okay, so it's not a very high, like 80-90% win rate. However, with just a 63% win rate, because again we factor in, as I mentioned, Sharpe ratio, we factor in standard deviation, right? We are able to net a return of more than 300% since October 2020. Okay, and the trade expectancy, which means that every trade we take based on this strategy here, we can expect an average of about 4% return per trade. Of course, some win, some loss, but if you average out, every trade you can expect to make about 4% return from there. And very quickly to just show you, we track all this. Okay, so you can see over here, since the very first trade we took in October 2020, ticker symbol ITW, and all this we track it publicly for all our traders as well. You can see over here, the hidden one are basically trades that are still running. Okay, they are winning, their losses. There are some big wins, some bigger loss as well. Like here, 40+% down on that trade. But overall, okay, we actually made about 400% ROI since the start of this, right? Since we actually publicly share this with our traders. So this strategy based on just seasonality, there's no real like technical chart to that. Okay, there's no like fundamental analysis to that. But the sole analysis, the main analysis over here is really just looking at statistics based on historical pattern, and then we make a decision like what we want to do in the future, right? Moving forward. Okay, so that's the aspect of how we apply seasonal to the stock market. Okay, you can apply this in the currency market as well. However, from my personal experience and opinion is that you probably want to add on a little bit of technical analysis in the FX market, because there are so many more factors that are affecting the equity side of things so many factors more that's affecting the currency market as compared to equities. Okay, so give you an example, right? This week here, we're actually looking at pound Canadian, where it has a seasonality of rallying, right? In other words, same process. We look at pound CAD for the past 10 years, right? This week, pound Canadian has a high probability of rallying, okay? And based on that, we'll establish, okay, with that historical pattern, I'm gonna be focusing more on the buy side for pound CAD, right? Because past 10 years, there's a high chance it rally. But I'm not gonna just buy into pound CAD immediately or blindly like that, just based on seasonality, because there are so many other factors that's affecting FX, right? So I would like to add in a little bit of technical analysis over here, okay? And of course, for the past few weeks, we have been going through various technical strategies, okay? You can, of course, use one of them to complement this in terms of seasonality, okay? And of course, for me, I'll use a very simple Elliott wave principle, which is also one of the sharing that we did. Okay, one of the strategy we talk about Elliott wave made easy, right? The idea is when we see an impulse push, we see a tiny bit of consolidation or a flat pattern like that. The technical chart is also suggesting the probability is to the upside, right? And again, if I combine these two elements over here with seasonality telling us upside for pound CAD, technical analysis also telling us potentially upside for pound CAD, both are in alignment, then of course, for me, in terms of FX, then I'll be looking to trade pound CAD to the upside. All right. So that's the kind of like approach on seasonality. Okay. Not much of a drawing because there's no chart pattern that we look at. Seasonality is really just based on historical stats, historical patterns, historical price movement. We do some analysis from it, and then we can't make a decision on whether to buy or sell, which one to buy, which one to sell. Okay. So yeah, that's what I've prepared to kind of introduce you to what seasonal analysis is for today's sharing. Okay. As I mentioned, the objective of all this webinars, all this sharing over here is to kind of like quickly introduce you to many different strategies. Okay. And if let's say some of this or one or two of these strategies that we share kind of like align with your interests, okay, and then that's something that you might want to then spend a little bit more time to dive deeper into it, to understand it. Definitely need to practice into that, okay, to kind of acquire that skill set as well. Okay, so yeah, that's all from me for today. I hope this sharing give you a better understanding of what seasonal analysis is. Okay, and for those of you who are interested, definitely you can start looking more into that. Okay, so that's all from me. All the best for those of you who are trading the market this week. Okay, if you're looking at FX, then you can definitely look out for pound CAD. If you're looking at equities, then for this week, really not that much. But I'll give you one hint. Okay, we are looking at company here called Lewis Companies Incorporation. Ticker symbol LOW. Okay, this week has a seasonality of rallying as well, right? So if you're looking at equities, give you one hint over here. Look out for this company LOW, right? Ticker symbol LOW. Right, so that's all from me for today. All the best. See you guys next week again. Bye bye.